to us, but we don't know the future. So if we wake up 6 months from now and the spot rate is actually at 190, then we're kind of upset because we sold it for 180, but it's actually trading for 190. If we wake up 6 months from now and the spot rate's at 170, then we're thrilled because we sold it at 180, and had we waited till 6 months from now, we would have gotten a lower exchange rate for our dollars into euros. Okay. So the one thing I want to point out is that when we're talking about options on currencies and futures on currencies, that the notational values are going to be multiplied by 100. So our 6 month forward for the dollar to euro is 1.8. We're going to quote that as 180. So that's why I've been saying 180 and 190, just to make sure we're clear on what the notation is. Example 1, suppose you sell forward at 180, i.e. 100 euros equals $180. Provide the payoffs for the forward hedge for the following spot rates at maturity. So we're going to look at a whole series of spot rates, and we're going to graph the payoff function for this strategy. Our payoff is going to be on the vertical axis, and the spot rates at maturity are going to be on the horizontal axis. Let's take a look. What do we see? We can see that because we sold forward, we're really, really hoping that the spot rate 6 months from now is equal to or less than 180. If we observe that at maturity, the spot rate gets above 180, so to 210, 240, and etc., we can see that we've lost money on this hedge. We've effectively lost out on this hedge. Well, this is just because we've agreed to sell forward. What would it look like if we bought forward? Had we bought forward, it would have been the exact opposite. So if we expect the price to go up and we buy forward, we can see that we have the exact opposite, a flip of what happens when we sell forward. Okay, so there's one thing I want to point out. Two things I want to point out. First, hopefully it's clear that if we were to buy forward, as long as the spot price at maturity, ST, 6 months from now, is equal to or above 180, we're quite happy with our hedge. If it's right at 180, we've hedged perfectly. If it ends up being above 180, then we're even happier. Notice how if the spot price is below 180, if we were to buy forward, then we're unhappy with our hedge. Why is that? Because we'd be losing money. It's the exact opposite of whether or not we sold forward. So we've got to figure out a way to do better than that. Meaning there has to be another hedge strategy that we can use that doesn't have these large negative expected values. Let's take a look. We're going to use options. So what should we do? Should we long an option? Should we short an option? Previously, we looked at what happens if we sell forward. We compared that to what happens if we buy forward. What are we going to do with options? Example 2. Suppose you own a European call option with a strike at 180. Repeat what was asked in example 1, and now also graph the payoff function of the person who sold you the option. So we're going to look from the perspective of both the buyer who takes a long position in the option and the writer who's taking a short position in the option. Let's look. What do we observe? We observe that with the call option, if we have anything above 180, we have a positive payoff to our call option. We can see that. What do you see for the seller? Notice that for the seller, anything above 180 is a negative payoff. And again, for every dollar that we gain, it's a dollar that the seller loses. So we know that with the call option, if we expect the price to appreciate above 180, then all of that is potential upside. What's different than what we saw when we were looking at being long on the forward or buying the forward or buying forward is that now our losses are capped at 0. So when we buy the call option, our losses are bounded to 0. And that's wonderful. That is a wonderful hedge. I'm limiting my downside and I'm gaining my upside. Obviously, that's not going to happen for free. So we're going to have to pay for the call option. And we'll get into pricing these options in a little bit. We can see for the seller that as long as the spot price at maturity is below 180, the seller has 0 in terms of expected payoff. But once the spot price gets above 180, the seller has a negative expected payoff. And to be clear, the payoffs for the seller are potentially infinite. The spot price can go up, up, up to wherever. So the same way how as the buyer of the call option, we have the potential for bounded losses, bounded at 0, and infinite gains because our exchange rates, our spot prices, our commodity rates, everything can just go up. If you're writing it, it's the exact opposite. If you're writing it, you have the potential for infinite losses. Okay, suppose you own a European put option with a strike at 180. Let's do the same thing we just did for the call option. Let's take a look. What do we observe? What you observe with the put option from the perspective of the buyer, the person who buys the put option, notice that anything below 180 has a positive payoff. Why? We said because with the put option, we really want to sell high. We're trying to secure a high price to sell given our expectations. If you look at the payoff for the writer of the put option, it's the exact opposite. Notice how anything above 180 for the writer of the put option has a 0 payoff, and anything below 180 for the seller, for the person who writes the put, has a negative payoff. So when I buy the put, I'm trying to lock in a high price based on my expectations. And when I write the put, I'm really hoping that the price stays high so that you don't end up using the put. Okay, so if we expect euros to appreciate, we could long a call option on the euro to effectively secure the right to purchase the euro at a low price given our expectations. We can also short a put. We can write a put option to receive the premium P. What's the intuition? Well, we earn the option premium. If the euro rises, no one uses the put. Suppose the euro appreciates to 190 or any price above 180, which is the strike price that we've been using in our examples. The owner of the put would rather sell to the market for 190 than sell to us for 180. And if that's a little bit confusing, let's pause for a moment and make sure we're all on the same page. When I sell you the put option, I'm selling it to you for the premium. So you provide me a premium. Awesome. You have the right, but not the obligation to sell this security to me for 180. Okay. Suppose you observe that the actual spot exchange rate at maturity is 190. That means that you can take the same euro and sell it in the market for a higher price than you would sell it to me. No one would ever sell something for a lower price when they can get it for a higher price elsewhere. So why would the owner of the put not want to use it? Well, the intuition is that it would be out of the money. So to explain the option terminology, we say the option's in the money. If it's a call option, when the spot is above the call. If it's a put option, we say it's in the money when the strike is above the spot. So if it's a call option, we got our spot above the strike, S greater than K, you can use it. If it's a put option, again, we want to sell at a high price. So if we've got K greater than S, go ahead and use it because you're going to get that difference. The option's out of the money when those things aren't true. So for the call option, if you want to buy at a low price, suppose that the spot, so in our examples, we've been using a strike of 180. Suppose that the spot exchange rate is 160. Think about the call option. If the spot exchange rate at maturity is 160 and the strike price for our option is 180, then our call option is out of the money. Okay, well, let's think about that. If the spot market is at 160, that means that we can go to the market and we can go buy €1. We can go buy 100 euros for $160. If I can go buy $100, if $160 buys me 100 euros, why would I ever pay you $180 for those same euros? I can get it in the market for cheaper than I can get it from you. That's the intuition behind the option being out of the money. As an investor, as a speculator, as a financial manager, as any market participant, I'm only going to use the option when it's valuable to me. When exercising it has a payoff. If the option's out of the money or at the money, I would actually prefer to do nothing because a zero payoff is better than a negative payoff. So this is the intuition. And it's the same logic for the put option. We said that suppose we observe that the spot exchange rate is at 190 and our strike is at 180. Okay, well, for the put option, you're telling me that you can go take your 100 euros and sell them in the market for $190. You would never take your 100 euros and sell it to me for $180 because you can sell it in the market for more. So we always want to orient ourselves. Are we taking a long position on the call or the put? Are we taking a short position on the call or the put? Okay, so hopefully what's clear as we discuss this is that payoffs are different from profits. The payoff diagrams that we looked at before did not factor in the initial cost of the option. Suppose the option buyer paid $3.50 for the call option for example 2. What would be the buyer's profit? Well, the buyer's profit is going to be, again, the max of ST minus K, the max of the spot at maturity minus the strike price or zero, minus the cost of the option. What about the buyer? What's going to be the buyer's profit? Well, I'm sorry, what's going to be the writer's profit? Well, the writer, the person who takes a short position, the person who's supplying this option to the market, always has the opposite payoff and the opposite profit of the buyer. So what do we have? We've got a negative over all the things that we just had for the buyer. And what's the intuition? Okay, as we saw from those payoff diagrams, it's clear that the writer's payoff is going to be the negative of the buyer's payoff. But the other thing that we want to be clear about is that the writer still gets C. The writer still gets the cost, the premium for the option. So the writer sells the call option to receive the premium. And this is true for the put too. You sell the put option to receive the premium. So writing the option is going to be valuable. Suppose the option premium for the call or the put from our previous examples was $3.50. That is, the buyer of the options paid $3.50 for the right, but not the obligation, to buy or sell. What would the profit diagrams look like for the writers? So this is for the writer, not for the buyer. If I'm the writer, what's my profit diagram look like? Well, it's kind of hard to tell given the scale that I made the graphs at, so I apologize for that. But hopefully what you can see is that just above 0, you can see that there's a line. And what's the intuition? The intuition is that as long as that strike price is, as long as the spot price is below 180, if I'm the person who wrote the call option, I'm okay because I still receive my call option premium. For the put option, the exact opposite. As long as that strike price is above 180, if I'm the person who wrote the put option, I'm okay because I'm still receiving my premium. Generally, the deeper out of the money an option, the cheaper the option. And the deeper in the money, the more expensive the option. Why? Well, hopefully that makes intuitive sense. Clearly, if the option's deeper in the money, there's a higher likelihood that we're going to use it, so it's going to be more valuable. If the option's deeper out of the money, there's a lower likelihood that this option to buy or sell at this pre-specified price is actually going to be valuable. Okay, there's also an intrinsic value to the option. And the way to think about the intrinsic value to the option is this. The price of the option is going to reflect the payoff we would get from exercising the option at time t, right now. So typically you'll see this for American options where, again, because you can use the option right away, as soon as the option's in the money, you're going to use it. Well, that informs me that the premium I would pay for that option is going to be at least equal to the expected payoff that I would get for that option. And if that doesn't make intuitive sense, let's think about it this way. If I told you that you could use an option and buy this currency from me for 180, and right now it's trading in the market at 210, you're going to use that option. I know you're going to use that option. So clearly this right, but not this obligation, has value. I am going to take as much of that value as I possibly can as a market participant. So the least that I'm going to charge you is $30. Why? Because you can exercise this option right away. I might charge you more than just that $30, which is why it's greater than or equal to. And part of the reason why I'm going to charge you more is because there's also a time value to the option. So call and put options are typically more valuable when they have longer times to expiration. And hopefully that makes intuitive sense. If I've got more time before the option expires, then I've got more opportunity for this thing to finish in the money. And the last point is volatility. The more volatile the underlying asset, the more the more profitable our option strategy will likely be. So when prices are more volatile, of course, the call and put options are going to be more valuable, because if prices are moving up and down, there's a higher chance that my call is going to finish in the money or my put's going to finish in the money, because the price is going to move back and forth. So what do options look like in the real world? Okay, so this is that same Euro FX option that we used when we were talking about the start of our lecture. What am I showing you? These are contracts, monthly options on one future contract for 125,000 euro. You can see the trading hours. So this is for the CME, the Chicago Mercantile Exchange. This is constantly being traded. There's open outcry, and then we also have the clearing mechanism for the option. Okay, what does that trading look like? So this is for the Euro FX future for December 2021 maturity. And hopefully what you see is that there's quite a bit of trading activity. So you can see what we call price discovery. You can see that the prices are moving up and down. And again, this is a heavily traded option. So there's a ton of trading activity that happens, and this is an option on a future. All right. So Now that we understand a bit more about options, about these very unique derivatives that give us the right, but not the obligation, we've already explored some strategies that we would adopt given our price expectations. Now let's take it a step further. What we're going to create are different option investment strategies that are going to be specific to our hedging beliefs, our needs, or even our risk appetites. So let's explore them. These are just some option strategies that are commonly used in the market. So the first is going to be called a straddle, where we're going to buy a call and a put with the same strike price. The next is a strangle. We're going to buy a call and we're going to buy a put, but the call and the put are not going to have the same strike price. Our put is going to have a lower strike price than our call. We're also going to look at spread trading. So spread strategies. There's a bull spread where you buy one call and you short another call. There's a bear spread where you short the first call and buy the second call. And remember, every time you short the call, you earn the premium. There's a collar where you buy the stock, you buy the put, and then you short the call. What are you doing with the collar? Because you own the stock, you really worry that it's going to fall in price. So this could be a stock, this could be an index, this could be a commodity, this could be anything. You worry that it's going to fall in price. So the way to protect yourself is by buying a put. Okay, buying a put is expensive. It costs money. How do you fund it? You fund it by selling a call. You short a call. And then, of course, there's going to be a butterfly because there's always really fun names with these different option strategies. And with the butterfly, it's very involved. We'll look at a payoff diagram to make sure we understand what we're doing. But the intuition is that we buy a call, we short two calls, and then we buy a call with an even higher strike price. And as we do that, we're basically betting on price stability. So let's look at some of these different option strategies. The straddle, what did you do? You long a call and a put at the same strike price. So again, we're assuming that the spot rate at maturity, the exchange rate for the euro, is 180. And again, we're keeping the quotation, the notational amounts. So that's where everything is coming from. Look at our payoffs. Our payoffs are going to be the max from our call and the max from our put. Notice how as long as the spot rate at maturity is anything below 180, if it's below 180, then we get the payoff from our put. If it's above 180, then we get the payoff from our call. So we're really betting on movement in either direction. Essentially, we're betting that the spot rate will be volatile. Let's compare the straddle to the strangle. So here we long a call with a strike of 210, and we long a put with a strike of 150. So what do you observe? There are two things, hopefully, that we observe right away. First, we can see that the strangle is also betting on quite a bit of volatility. We're betting and anticipating that the spot rate is going to move up and down. We don't know which direction, if it's going to go up or going to go down. We know it's going to move a lot. We also can observe that we need that spot rate at maturity to move around a lot more than we did with our straddle. In other words, the expected payoff of this investment strategy is lower than the expected payoff of our straddle. So why would we expect this to be cheaper or more expensive than our straddle? Well, we're taking a very similar investment strategy to our straddle, but we're using different strike prices. So in this case, we would expect it to be cheaper than our straddle because it has a lower expected payoff than our straddle investment idea. Okay, a bull spread. So we said that if we expect the euro to appreciate, we should long a call. Longing a call or buying a call still costs money. Suppose instead we do a bull spread. So we long a call with a strike at 180 and we short a call with a strike at 210. Why would this portfolio be cheaper than just longing a call? Intuitively, we're going to earn the premium. So the call that we write, the one with the strike price of 210, is going to have some premium. So we can use that to help fund the call that we bought with the strike price of 180. What do we do when we do this? When we do this, clearly we're giving up some of the upside. So our maximum gain is really here just 30. Whereas before, our maximum gain was infinite because the spot rate at maturity could go up to anything. So here we're locking in a level of profits, but you'll notice that our losses are still bound at 0. So the reason why we would adopt such an investment strategy is because it's cheaper than just buying a call option. And in exchange for that, we're also reducing our potential for payoff. So of course, there's this trade-off. It's cheaper, but why is it cheaper? Well, we must be giving up something in order to have it be a cheaper portfolio strategy. Our last portfolio strategy that we'll take a look at is the butterfly spread. So what are we doing? You long a call with a strike at 120, you short 2 calls with a strike at 180, and then you long a call with the strike at 240. What are you doing with a butterfly spread? With a butterfly spread, you're really betting on the exchange rate being stable. So you're basically betting that it's going to be somewhere around 180. And you can see that from the payoff diagram. The reason why you would do such a strategy is because you might observe that there's a lot of volatility in the exchange rate market, or you might observe that market expectations are all over the place. Some people think that a good thing is around the corner. Some people think a bad thing is around the corner. For example, as we saw with Brexit, when we did the event study, we observed that as we were getting closer and closer to the vote, you could see that the actual exchange rate was appreciating somewhat against the dollar. So as this uncertainty is being resolved, people tend to trade and impact the stock price or impact the exchange price or the commodity price as this is happening. But we still don't know how things will turn out. So if we expect that commodity prices, future prices, stock prices, oil prices, pick a thing, if you expect that these prices are going to be stable, we want to figure out a way to bet on that expectation. So we'll use a butterfly spread. So what's the big picture? Hopefully, we are very comfortable with a call and a put option. We understand that these are derivatives that provide the right, but not the obligation to buy an asset at the maturity date. And hopefully, we're also comfortable with different trading strategies that we would take given our expectations. So if you think that a price will rise, you can long a call, right? You can lock in that low price, buy low. You can short a put. You can write a put. If I expect that the stock price or the commodity price or the exchange rate is going to go up, I'm going to write a put. Why? Because I'm going to earn the premium for selling you the put, and I'm going to sell you something that hopefully you'll never use. And then we can also create a bull spread. And we saw with the bull spread that we're sacrificing some of that upside, but it's really a way for us to fund our price expectation. It's cheaper because we're going to sell a call. So we write a call, we sell a call, there's our bull spread. If you think prices are going to fall, we can short the call, we can write the call. Intuitively, if we remember our example, suppose that the exchange rate falls to 160 and we've written a call that has a strike at 180. The person who bought the call from us is never going to use it. Why? because they can take their 100 euros and they can go get it for 160 from the market. They're not going to get it from us for 180. That's the intuition. If you think prices are going to fall, you should certainly long a put. Sometimes puts are referred to as what people call protective puts. And the idea is that I really want protection against prices falling. So there are all kinds of interesting things that we observe when we look at option prices, particularly when we look at put and call prices. And this is part of the theory that we have, that because people really want protection from downside, they really want protection from price falls, that they'll pay even higher and higher premiums for the same level of protection, much more than they would pay for that same opportunity for the upside on the call. So if you think the price is going to fall, you can short the call, you can long the put, or you can do a bear spread. And if you think the price is going to be volatile, it's going to move around a lot, we said that you could do a straddle or strangle. Hopefully you're comfortable with what those two option strategies are, and you understand why one would be cheaper than the other. Lastly, if you think the option price is going to be, if you think the security price, the underlying is going to be stable, then you can do a butterfly. You can basically bet on the stability. And this is phenomenal. This is the first time that we've had a derivative instrument that's allowed us to take bets based on volatility, based on how much we expect things to move around. If you'll think back to your first problem set where you anticipated that the exchange rate risk was going to increase after the Brexit, one of the things that you looked at was the volatility of the exchange rate. You looked at the standard deviation. This is the first time that we figured out a way to actually make a decision based on our expectation of volatility. So that's phenomenal. Okay. So this will be our last module before the midterm. We will have a problem set that's going to help you to apply these option concepts and to perform some analysis so that you, again, have a really good understanding of what's being asked of you. There will be a practice test, and we'll have a review session on the day before the midterm goes live to make sure we address any last minute questions or any questions that we had from the practice tests. After the midterm, we're going to pick up right back where we're at, and we're going to apply this options approach to the firm's investment decisions. So we'll use real options to understand foreign direct investment decisions. We're going to look at the international CAPM, violations of the CAPM when we look at portfolios with home bias, and then we'll really get into some fun portfolio decisions. So we'll look at multi-factor models, ways of pricing equities. We'll definitely get into fixed income strategies, and we'll also have the opportunity to look at some different FX strategies. So hopefully we're very comfortable with options. We're very comfortable with having the right, but not the obligation. We understand this intuition of buy low, sell high. I want to use the call option to buy low. I want to use the put option to sell high. And then we kind of understand how, depending on whether or not we write the call or write the put, or buy the call or buy the put, we can make option strategies based on our expectations. You've learned quite a bit, so thank you.